Welcome everybody to the third day of the Finexus conference. Apologies for a bit delay. We're still recovering from the effort of yesterday, but today is still a very important day. We are now back into research, and the whole day will delve until 3 o'clock into particular financial networks. And there is a connecting story across the sessions. So let me take just 2 minutes to explain how they are interconnected. We start with a session that explores and tries to shed light on the relation between interconnectedness and systemic risk in networks of simple contracts. Relatively simple, because in Mauro's presentation there is actually rehypothecation. But there's a long story, and we have been working on this for many years, on studying the relation between interconnectedness and systemic risk. And so the presentation will be focused on precisely what their work is able to say on this precise question. There are some drivers of systemic risk in networks that have been highlighted by the literature. One is clearly interconnectedness and density. Another one is leverage. But we are working on trying to identify also the one or two other drivers where you could conceptualize the whole systemic risk in only 3 or maximum 4 dimensions. Then we move to the next session that start from the observation that there is an increasing portion of contracts and transactions that happens through complex financial contracts and in particular derivatives. And so the question is obviously, well, now we start to understand, and especially to make people in the scientific and policy community understand that the relation between interconnectedness and systemic risk is not that simple that, oh, a more interconnected network is always good. We're starting to make this understanding to make the community understand this, but very little is known about what happens when there are derivatives. And you will see that there are some very surprising things and interesting effects when there are derivatives. For that, however, to understand that the importance of data, not just models, but also the importance of data, is crucial. So the first session, we really have the pleasure and privilege that will be moderated by Christopher Koch, who's deputy head of the division and financial stability and macro linkage division of the European Central Bank. With whom we've been collaborating on analysis of supervisory data. It's really a privilege to have him here. He made it despite an adventurous trip yesterday. Then the second session will be moderated by Thomas Peltone, who is deputy head of the European Systemic Risk Board, and we're also very pleased to have a collaboration with them. Also, he made it despite a very late yesterday night. We're really thankful that he made it anyway. Another adventurous trip. And so he will moderate in the session on the importance of derivatives in financial networks. Then we move to the third session of the morning, which will address the question, well, what do you do when you don't have enough data, when you only have partial data? And this session will be moderated by Guido Caldarelli, who's been a leading figure in the field of financial networks now for many years. And I'm pleased that I've been collaborating with him for so long. So the first question is, there will be, if you have partial information about one network, what can you say about systemic risk? And then the other question will be, well, but even if I have full information about this network today, as it appears, does it tell me, how much does it tell me about its resilience and its stability properties tomorrow? Can I infer information about the, can I attach essentially an uncertainty or a confidence interval around the estimation of systemic risk using the technologies that will be presented. And in particular, that becomes even more interesting when the network undergoes some process. So if it's a temporal network, a dynamical network, how can I attach a confidence on my estimation of systemic risk? So this is the thread that connects the three sessions. And then in the first session of the afternoon, we will have two presentations, precisely by Tuomas Peltonen and by Christopher Koch. And so they will illustrate how network data and network models are currently used and integrated in the decision-making and internal to central banks. And, well, European Systemic Risk Board is it's actually an entity that is separated from the European Central Bank, but obviously has a very important role in the its mission is precisely to understand and provide recommendations to manage systemic risk. So it would be very interesting to understand how they have been uptaken these network approaches and what can be done more in order to make it, in order to mainstream it down to the, really to the top level decision making. In financial stability and macroprudential policy. So this is how, and we'll have really the privilege that Joe will be making some comments in the third session, sorry, in the fourth session, in this session about central banks, about how these network models could better inform the decision making. So this is the story that connects the next 4 sessions. Don't miss the last one. The last one, we go back to something that is essentially a practitioner session where it will be moderated by Katarina Serafimova, and it will address the question of, the title of that is A Reality Check for the Banking System. And there we will address the question of whether once we move the economy towards a more sustainable, more circular, what is actually the financial system that we need there? What kind of intermediary do we need? And are the current bank ready for that? So don't miss that important, we have also, we will have the CEO of Alternative Bank Schweiz. So it will be a very interesting session. So without apologies for this delay, we'll recover into the time into the coffee break and the lunch break. Today there is no poster session, so we're a little bit, the lunch break is 1 hour and a half, so we're a little bit, we have a margin to play with. But this session is 1 hour, and Isabel is keeping the time. So it's now time to give the floor to Christopher to moderate the session.
Okay, thanks very much, Stefano. So as Stefano mentioned, I'm Christopher Koch from the European Central Bank. I'm Deputy Head of the Stress Test Modeling Division of the Directorate General Macroprudential Policy and Financial Stability. Closer to the, yeah. So I'll be moderating this session on endogenous financial networks and the price of systemic risks. So Stephanie already explained a bit what we're going to look at. So it's well known that, say, there's a trade-off between risk diversification and contagion. And this session will examine, say, the relationships between the architecture of financial networks and their ability to amplify shocks, both in a static and also in endogenous link formation settings. So in the panel today, I will have from my right, Mauro Napoletano, who's a professor at Sciences Po. He will do the first presentation. Then we have Marco Derico, who is from the European Systemic Risk Board, but I think also a postdoc here from the University of Zurich. Then we have on my left Paolo Baruca, who is also a postdoc here from Zurich, but I understand also now working in London, from London. And then we have on the far left, or far right from your perspective, I suppose, Alan Roncoloni, who is a PhD student here at Zurich with Stefano. So before giving the floor to Mauro, the first speaker, I would like to, for all the presentations, ask the panelists to address the following questions with the work they are presenting now. So first of all, what are the key drivers of systemic risk in networks? So we know that interconnectedness and leverage are important, but we also know that without frictions, interconnectedness may not be systemic in itself. So what are the, say, negative externalities that affect systemic risks beyond just interconnectedness and leverage? And how do these elements interplay, and what are, say, in general, the conditions for the emergence of systemic risks in financial networks? So without further ado, I would give the floor to the first speaker, Mauro, and I understand you have 15 minutes for your intervention, and time is being taken by Isabella.
Okay, thank you very much, Christopher. So, yes, my presentation, which comes from the result of a joint work with Duke, Lu, Paolo, and also with Stefano, focuses on practice of rehypothecation. Basically, what I will try to show that interconnectedness can have some advantages in terms of liquidity, higher liquidity in the system. At the same time, it's characterized by a trade-off by liquidity and the fact that when shocks hit, the damages can be larger. Okay, so there is a trade-off between liquidity and systemic risk. Now, basically, we try to show this trade-off by focusing on a model of rehypothecation networks. Now, what is rehypothecation? Well, I think I don't have to convince many of you in the room that collateral is very important nowadays in modern financial systems. Rehypothecation is basically a practice that gives the right of the receiver of a collateral to reuse the same piece of collateral to secure another transaction. Now, there is clearly an advantage in that practice, the fact that the same piece of collateral can secure several transactions. Okay, so in this case, can expand the market liquidity in the system because you can generate more contracts, and so on and so forth. At the same time, there is also risk inherent in rehypothecation. That is the fact that the same set of collateral secures more than transactions. And so several lenders, then it comes out that several lenders must count on the same underlying collateral as backup in case things go wrong. Now, this implies that when rehypothecation is in place, the balance sheets of financial institutions becomes interlocked. So it's yet another source of interconnectedness, okay, in the financial system, and can also then become also yet another channel of distress propagation. So what we do in this work is basically to study under what condition the network of secured collateral generates endogenous collateral, that is an amount of collateral and therefore of liquidity that is larger than the initial endowment of proprietary collateral, of nodes in the systems, of banks in the systems, and then which network structures generate larger liquidity losses following small local shocks. I'll be brief. This is the what we have in equation 1 is basically equation 1 tracks the dynamics of collateral. This is the outflowing collateral from each node. So it's the contribution in terms of collateral from each node in the network. And so here you have, this is the component of the proprietary collateral, and this is the component due to rehypothecation. Okay, now this is a non-hoarding parameter. This is the fraction of non-ordered collateral. So how much of the collateral that goes through a node then is recycled by the node. Okay, it's not ordered. Now that simple equation can be written in matrix form, and you can then find, you can solve that equation having an equilibrium vector of outflowing collateral that basically determines the total amount of collateral as a function of the links in the system, and also as a function of these hoarding parameters. Basically, what we do is that, given that dynamics of collateral, then we study how different networks generate different amounts of endogenous collateral in the system. In particular, we focus on two variables. One is the total amount of collateral that is generated, and then the other one is the collateral multiplier. Okay, the collateral multiplier is defined as the ratio of total collateral over the total proprietary collateral that banks had initially. Okay, now we call it multiplier, but in the end, what it is the velocity of collateral. The higher is the velocity, the more liquidity in the system. Actually, it's very similar to the idea of the quantitative theory of money. Okay, you have a given set of here collateral, and then the higher is the velocity, the larger is the amount of transactions that you can generate. Okay, and so different network structures can generate different amounts of M. Okay, so we focus on which conditions, on the geometry of networks that allows this, and there are some interesting things that come out. Okay, first, yes, here you have three examples: star chain, open chain, closed chain. Now, this structure generates endogenous collateral, and the longer is the chain, the longer is the amount of endogenous collateral that is generated. The star chain here does not generate endogenous collateral, because here all the collateral then is synced at node 2, is not recycled. Here instead it is. It generates endogenous collateral because there is a piece of collateral that is recycled by node 2. But the closed chain, here, the cycle generates even more collateral, okay, because actually collateral is recycled by all nodes, okay, there is no sync. Okay, so first, so the length of chain is very important for the amount of total collateral that is generated. Second, cycles generate with the same density, level of density of the network, generates more collateral, okay? Now, here I have other two examples. Now, the first is, there is an important difference between the example in the bottom and the second. Now, in the first example, you see here you have different length of cycles, but they all generate the same amount of total collateral. Okay? Instead, in the examples in the bottom, the length of cycles matter. Now, what is the key difference between these two? Here, notice that, for instance, then collateral is provided by node 1 to node 2, and then is recycled here. The same thing here. Okay? Here, instead, there are some nodes that act as sync. Okay? So notice that here the collateral goes out of the cycle and then ends up at node 5 is not recycled. Okay? So as long you have all nodes have positive out degree, even having a very small cycle, okay, it's enough to generate a very large collateral. Now, this is important because then later on I'll show you that actually there are some structures called peripheries that generate very large amount of collateral, but because they able to generate a situation like the one that you have in this example. Okay. Now, then we played also with different structures. Now, here you have this slide shows that there are some advantages from concentrating collateral flows. Now, you have two examples here, random graphs and core periphery graphs. Now, random graphs, links are spread randomly. You have some heterogeneity in links, okay, but it's not that large. In core periphery, instead, that heterogeneity is very large. Now, what you have here is the density. Sorry for that. Now, notice that as density increases, okay, the collateral multiplier also increases. But the point is that core periphery graphs generate much higher collateral already with a very low level of density. Notice that what you have here is the density on the core, and this is the overall density. Now, compare this overall density on the right with the one on the left. Notice that here there are already a very small variations in density in core periphery is already able to generate the same collateral that you get in random graphs, but with a much larger density. So there are clearly some advantages from concentrating collateral flows among few nodes. Why? Because this generates larger amount of collateral. Why? It's exactly for the reason that I explained before. Okay? Because when you have a core periphery, the core can generate this cycle. Okay? If there are no sinks, okay, well, then the system is already able to generate the largest amount of collateral possible. Also notice that all multipliers as density increases converge to in the limit to the same value. Now, okay, so clearly there are some advantages, okay, from replication. Clearly generates, notice that here multiplier all larger than 1 means that the system, okay, when you have these types of structures that are all connected, okay, these are all connected graphs, moreover, okay? So generates, is able to increase the liquidity. But then point, okay, what happens then when some local shocks hit the system? Well, in order to understand this, now we have to move to an endogenous framework. Okay, endogenous framework, it's in the sense that what we do is that we keep the links the same, but now the hoarding and non-hoarding parameters now can change. And how do they change? Well, we assume that basically each bank decides the amount of collateral to hoard and not to hoard on the basis of a value at risk criterion. Okay, so basically we assume that, so the idea is very simple. Suppose that each bank has a net liquidity position, and then can be, this is the gross liquidity, okay, and then that can be hit by small random shocks. And then simply wants to keep, and if that shock is large enough, then the bank will default. And so what the bank wants is to keep this probability of default below a given threshold, the value at risk threshold. Now this generates a situation where the fraction of non-ordered collateral is given by this equation. It's dependent on the amount of collateral that the bank has, okay? But notice that this ACJ is a function not only of the collateral, of the proprietary collateral of that bank has, but it's a function of the whole topology of the network, okay? Because depends also on the collateral that each node receives from its neighbors and the neighbors of its neighbors, okay? Now the interesting thing is that now you can already see that now when these fractions can change as a result of value at risk criterion, now there is some externalities now that are generated, because when I'm hit by a small liquidity shock, then what I will do is that I will change my ordered collateral. So I will hoard more collateral, but if I hoard my collateral is connected to me, then you will be forced to hoard more collateral. And then there will be a whole chain of externalities that will travel along the chain of rehypothecation. Okay, now let me emphasize that so also in relation to the question raised by the moderator and also by Stefano before, the key point, I mean, these presence of externalities that travel through the network are fundamental in order to achieve large effects when you have small local shocks. Why? Because if you have that these fractions are fixed, okay, then of course when you rehypothecate, okay, I rehypothecate, but at each time along the chain, someone is hoarding collateral. So when you go at the node at the end of the chain, the effect will be basically of order n. Okay, so will be second, third order of nth order. Okay, at the end of the chain. So if there is a shock at the end of the chain, and there are these externalities are not there, the effects. The overall effects will be small, okay? Instead, if these externalities are present, even small local shock at the end of the chain can have large effects, okay? So I would like to emphasize this fundamental aspect of that model. Now, what we do is now to, to compare the effects of local shocks under different structures. So here you have, basically we compare three structures. The regular network, okay, where every node has the same number of links. Again, the random, this is the dark line. Then you have the random graph, okay, in green. And then the core periphery graph is instead, is this line, okay, is the pink line. Now, and then we basically, what we do, okay, what you have on the left is the multiplier before shock, so it's the amount of endogenous, sorry, not the multiplier, but it's the amount of endogenous collateral before the shock. What you have on the right here, on the scale on the right, is the amount of collateral after the shock. Okay, now what we observe, and on the left we have a situation where nodes are hit randomly by local shocks, are picked at random. What we have on the right instead is a situation where some specific nodes are selected. Okay, it's a target attack. In particular, when core periphery is considered, we attack nodes in the core. Okay? Now, it's interesting to consider now the effects of these two. Now, what emerges is that some structures are clearly characterized by a trade-off between liquidity and systemic risk. In particular, this is the case for core periphery graphs, okay, especially under target attack. You see that as density increases, we move from left to right, liquidity increases, but at the same time, the losses are very large when small local shock hit. Instead, this is not the case for regular networks. Okay, regular networks, okay, you see that okay, they generate collateral, but they are not, basically the loss when a local shock arrives is very small. And it does not change with density. So I basically conclude these are the take-home messages. Interconnectors can be, it's good for liquidity, but it can be a problem, okay? And the problem is when these externalities, okay, are present, okay, hoarding externalities are present, and second, concentrating collateral flows as an advantage in terms of liquidity, but it can be very dangerous, okay, in presence of these negative externalities. And so, and also some networks can be characterized by a trade-off between, therefore, in presence of all these factors by liquidity and systemic risk. Okay.
Thanks very much, Mauro. So we'll take all questions at the end of all 4 presentations. So next, I will give the floor to Marco.
Thank you, Christopher. Thank you, everybody. So this is not a presentation on one paper. It is, sorry, can you hear me? Yeah. So this is not a presentation on one paper, but this is more a wrap-up of what I personally have learned in the years we've been working with many co-authors on systemic risk. And I decided to call it Taming the Financial Network, a bit to, imitate the beautiful speech given by Andy Haldane some years ago, which was entitled Rethinking the Financial Network. And what I learned, I think, what I want to share with a number of co-authors, including Stefano, Thomas, Iñaki, Alan, everybody here, is that financial networks are not a given entity that cannot be tamed. So interconnectedness, while it has trade-offs, can also be engineered in such a way that we can reduce losses and mitigate systemic risk. So, of course, the usual disclaimers applies, the views are my own. So, there are 2 main open questions, I believe, after the crisis, 10 years after the crisis. And the first one is that, okay, I don't know if you realize, but 10 years have passed since the global financial crisis, and I don't think we have understood everything we should have. So we are starting now to get some facts straight, I believe. So 10 years ago, financial institutions were largely interconnected by mutual obligations, and 2 main questions are still open, I believe. So is interconnectedness a shock absorber or a shock amplifier? And how much interconnectedness, if we can measure, is good or bad? So do we have too much interconnectedness or too low? And the main answer to this message is the following. So the more uncertain, the more opaque we observe the financial network, the more loss amplification and destruction of value we will have, and of course, the more endogenous leverage we will create. But there is an interesting consequence of this, that is the more transparency that foster confidence of a system to itself can lead to limit losses, even towards loss conservation and do endogenous deleveraging, which I will show you later what I mean by that. But there is a shift that needs to be done, and then my presentation is actually largely non-technical for these reasons. because we need a large-scale cultural shift in finance to achieve this type of results. And I'll try to explain you why. Last year, when I was invited to speak here, I presented the paper where basically we show this equation to understand whether an interconnected system amplifies or preserves losses in the system. So we had a shock on the housing markets 10 years ago, and then has this spread out because of risk transfers, or has this amplified and destructed wealth? Well, the answer to that is that shock, the original shock in percentage, has a part that is amplified by so-called interfinancial leverage. That is the amount of leverage that is due within the financial system itself. But the answer to this is even more nuanced, I believe. And it depends on three elements. This is a paper we did, I think, a couple of years ago, which I think it surprised me a lot, to be honest, what we found. Is that the more transparency you have in the network, the less uncertainty you have, the less losses you will see. Network structures also matter, but only if the first prerequisite is met. And then there's a point on asset mispricing, and I put miss in parentheses because I'm not quite sure about what that means yet. Maybe in a year I will be a bit more precise to that. So there is a key policy implication, that is the more transparency you have, the lower you have systemic losses. And perhaps even in case we need to help the financial system in any way, the less losses for society. So here comes the motivation for my talk. That is this one, which is, I find it quite telling. So this is a beautiful speech by Andy Haldane, which, in my opinion at least, teaches much more about systemic risk than any of the many things that we have come to learn in the last 10 years. After Lehman Brothers filed for bankruptcy, panic ensued. Uncertainty about its causes and contagious consequences brought many financial markets and institutions to a standstill. The credit default swap markets froze as Lehman was believed to be counterparty to around 5 trillion of credit default swap contracts. Now, you can look at that and be surprised. To me, the element that is key here is this one. This is, how can we tell who was believed? How can we tell that someone had an exposure of 5, whatever that number is? And that begs the next question, that is, who should have known? So you may think the chief risk officer of Lehman had this answer. Anybody else in the market had the answer. We have a very fancy and articulated model to estimate probabilities of default. But what if we don't even know the exposures? How can we estimate that? A beautiful, I believe, blog post by Cecchetti and Schoenholz recently on Vox EU kind of contains the answer. So prior to the global financial crisis, you would have thought that the CEO would be able to push a button and get the exposures of the bank. The problem, or in case they're not technologically savvy, they could call someone else to do that. This is not even close, and it has been shown. So we do have a problem with risk management. We do have a big problem with risk management, at least we did back then. But then people say, but come on, how come we don't know? We have numbers about aggregate size of OTC markets. Aren't these enough? So look at these stats. This is BIS data. They collect survey data on aggregate size of derivatives market. This is credit default swaps. I don't want to go too much into the details of this picture because the time, I have 15 minutes, Isabel. Give me 5 minutes more. So here you see the size of the credit default swap market shrinking from 60 trillion in the crisis to 10 trillion after the crisis and now. Does this mean that we have less risk? And why has the market shrunk tenfold or sixfold, however you want? And this begs the question, what does it mean, 60 trillion of credit default swaps, in any case? The aggregate number doesn't tell you anything that you really need to know. But if you have data and you go at the granular level, this is the picture. So we had data at some point. This is not yet regulatory data. This was back then when it was on a more demand base. When you disaggregate and you get transaction level data, you can plot a network. And when you plot a network, you see that the large level of intermediation of this market that you see here lies on closed chains, like the ones that Mauro was referring to. And if I have to tell you, where does all this notional lies? Here, you have 80% of the notional, and customers have only 10%. So we have a market that generates endogenously 80% of intermediation. So you can start drawing a little map, a little stylized map. But the market is very complex, opaque, and large. And the policymakers had to make a decision. So the G20 leaders met in Pittsburgh 2009, and they decided that we needed to reform the market. And I'll tell you what these reforms constituted a bit later. But what can you do with data? And what does it mean that we have closed chains of intermediation? So this is what I was referring to. When you get the data, and this is what we get, now counterparties are forced to report, they are mandated to report to trade repositories this data. You can do something very interesting, and I'll show you what. Imagine you are counterparty A in this network, and you expect to receive 1,000 from C, and you need to give 1,000 to B, okay? So you are dependent on C to receive your money and give it back to B, okay? Now imagine C has a problem, and they are distressed, and they cannot give you the 1,000. You start worrying, right? You don't have enough money. You may default, contagion. But what if I told you that we can have the full picture of this network, and we find out that B owns 1,000 to C as well? At that point, we can remove all these obligations from the market. They go away. So your contagion is no longer a problem, and your size is no longer a problem, because your balance sheet deleverages endogenously without having to raise capital, without having to sell assets in a fire sale mechanism. You just share information, you optimize ex post. And now you may say, this is a practice that is called compression. And now you may say, well, but this is absolutely insane. This is some kind of magic. It does not happen in reality. It does. So, and here was 10 years ago, this is another very interesting article. The Federal Reserve had tried to untangle the credit default swap market, the positions of Lehman, calling a group of experts. And in order to unwind these trades, they had to do so-called portfolio compression. The problem is that it couldn't be done because of the data. So the economists echoed these findings by saying, only now, after the crisis, is the industry discovering the joys of compression, which allows to turn out offsetting swaps, a staggering 20 trillion worth, almost half of the total, has been in recent months. So what is compression? It is a post-trade operation. It has anything to do with the way you trade, you establish a price. It is also a system-wide deleveraging process that only requires information. It does not require you to sell assets. It does not require you to recapitalize. It was introduced in the early 2000s, and if it's so good, why didn't we use it back then? It has also been called the greatest source of improvement in OTC derivatives exposure. And I believe, to me, the reason is this. First of all, to do that, you need granular data. And the more participants are in this network, the higher the efficiency. You need a collection of this data. So once you trade, you need to keep the data. So you cannot gauge your exposure by saying, I was believed to be exposed by that amount. But it also requires an ex-post optimization. And this is largely done by private providers with proprietary algorithms. So is this engendering opacity for the regulator and from the supervisor, as it has impact on capital requirements and margins? And of course, the institutional framework is very important, because if there are not binding agreements of this optimization, we can run into problems. Now the question is, since this has an impact on all these quantities that are crucial for financial stability, so capital requirements and collateral, can policymakers understand the systemic risk implication? Can we replicate these exercises that are taking place in the market? And the answer is, well, if you're good at reverse engineering the algorithm, yes, but more importantly, you need much more the granular data. If you don't have granular data, you cannot replicate that. You simply can't. There's no way to do it with aggregate data. Luckily, we have access to this data, so the European Market Infrastructure Regulation gives access to some authorities about the data. And we have ongoing projects with Thomas and Tariq Rukni about understanding the implications on margins and capital requirement and the procyclicality of these margins. These are the results. As you can see, we can eliminate you should look at the blue box plot. We can eliminate around 80% of the notional in the market. so full optimization hasn't been reached yet. And there are some technicalities for that. I don't want to go too much into detail. So to conclude my talk, I believe that what went wrong, apparently part of what went wrong 10 years ago, is that we didn't have the, let's say, intellectual instruments to understand what was going on in the markets. So we need a cultural shift. And this is the cultural shift I propose here. And I hope we can discuss about this. First of all, we need a shift in risk management culture at the individual and at the system-wide level. That is, a trade is not a trade. It's something that creates an exposure, needs to be reported, needs to be kept track of. So less fancy models, more good reporting, more good accounting can help. We need to foster confidence and self-reliance on the financial system. 10 years ago, the financial system lost confidence in itself. How do you avoid this next time? You need to create a transparency-oriented culture where opacity goes away and there is a clear understanding of each other's position. Paolo, I guess, is going to talk a bit more about what happens when you have uncertainty in the picture and volatility on what you're... So this can only be achieved when you have millions of transactions. It can only be achieved if you standardize data reporting. Only now we are starting understanding who are the legal counterparties in the market. And we had, a great effort led at the beginning by FSB was into creating a standard for legal identifying your counterparty. So there is a legal entity identifier. Other people are now starting identifying trades with unique trades identifiers. This is very important. You need reporting. Reporting has to be constant, precise, but it has to be granular. Because like I showed you, if you collect data at the aggregate level, you're missing a lot of what's going on. You're missing basically the essential features. The second problem is educational, and I believe here is the right place to say that. Finance people are not used to this. I haven't mentioned probabilities of default. I haven't mentioned risk measures. I haven't mentioned prices here. But yet, we can eliminate a lot of risk without using these quantities. So what is a probability of default if the probability of default is endogenous? The second point is that the reason why it's very difficult to teach these things is because academic research is lagging behind a lot. And rethinking about this concept is very important. Okay. I'm ending here, so I'm happy to take the questions later. Thank you very much.
Okay. Thank you very much, Marco. So let me immediately pass on to Paolo. So I think to keep within the hour, we should probably try to stick to 10 minutes, if possible.
Yeah. Thanks a lot. So 10 minutes started. Hello, I'm Paolo Baruch. I'm a postdoc at Zurich, and I'm now currently working at London Institute for Mathematical Science in London and collaborating with the Bank of England, and I'm an associate at Oxford. All the research I'll be talking about was developed during the Dolphins project, supervised by Professor Stefano Battiston. So I will try to give this network perspective to systemic risk and try to answer the question that what leads to systemic risk through networks and why networks are relevant for systemic risk. And I really like the talk by Marco Dorigo and of course also by Mauro Napolitano, but the point on transparency is very, as I'm a co-author also of the work, so it would be ironic. So speaking about transparency, it's very relevant as network basically is information. And what we are saying basically is this information on network is not irrelevant, is relevant to measure risk. So basically network is information and network models is a way to process this information and translate it into risk measures. So this is just a sketch of like a no network word. I'm sorry, you cannot see the words on the top left, but this is a no network words, just balance sheets, just assets of the biggest banks in Europe in 2017. So you don't have links here, you just have the size of these banks, and then you expect to measure the probability of default of each of these banks separately without thinking about the network. But of course, the real picture, it looks more like a monopartite network, which is something more similar to this, that like Marco showed or Mauro showed in a network of contracts that might be between different institutions. So I just wanted to show you this information, which we claim is relevant and which is evidently relevant also after the crisis. So you may have these networks of financial contracts between institutions, perfect, thanks a lot. Between insurance companies, banks, investment funds, and you have this kind of monopartite network. So you have financial institutions that have links between each other. And a typical framework that we worked on is, for instance, considering interbank network. This is like a three-bank system with exposure to external assets and interbank liabilities. So in this kind of framework, you can evaluate the equity of a bank, no longer naively just looking at the bank separately, but trying to connect those equities. So the question here is, what is the net value? What is the equity of an institution embedded in a network? And ideally, to actually compute this equity, you would have not only to collect all the contracts that that institution has, but collect all the contracts in the market, also as Marco was saying, in terms of transparency, to actually know what is the real value. Because the real value will be depending on all the contracts that this institution have. This is a typical framework that will be applied also, I believe, in the next talk, and where you have to reevaluate like the value of a bank depending on the other bank in a process of amplification until you reach a fixed point, which is an equilibrium where you can compute an equity for each bank that goes beyond like a naive, isolated system, so that takes into account both the network of connection, so possible frictions in the network of connection, so when the payments do not occur, what happens if there are solvency prices, or there is a stochastic process on the external assets. And you want to incorporate that in your model, the network, the recovery, and the uncertainty all together in a single model. But this is still a monopartite world. And so this is, for instance, is what you get in the case of applying this kind of model on regulatory data, again, so where you actually get your hand on the data, you get, for instance, this is unsecured loans. We saw basically with the Bank of England that unsecured loans decreased their market portion in the last, now 10 years. And we also, what we try to do here is to disentangle the contribution that is coming from a single network perspective. That is the fact that since there are less links, so less exposure, the probability of contagion decreases. But also, if you increase the equity of each single bank, the probability will decrease. So you can try to disentangle the change in contagion losses due to equity, like a bank-directed, like a node-directed policy, or exposure-directed policy, where you try to eliminate links. So you may want to try and disentangle these two effects. But as I was saying, this is still a monopartite perspective on this issue. Let's try to take a look at the bipartite perspective on it, meaning that you no longer have a network between nodes of the same kind, so financial institutions, but you may also have links between financial institutions and contracts and financial institutions, meaning that the link between financial institutions is mediated by these squares, these contracts. This is very useful in the sense that you can model, of course, bilateral connection, so loans, but you also can model CDSs in this way, so with factor graphs. So this is also a more general and useful representation of network of contracts that goes beyond bilateral connections. So this is a generalization of the usual network of contracts with a bipartite kind of graphs, where you see all the direct connection that you had between financial institutions are now mediated by contracts. So you can gather all the information if you want to model and simulate the system within the contract. A natural representation of this kind of a bipartite network is the case of security holdings, which is even more natural. So you are not mediating the link between two financial institutions with a contract. You're just saying, okay, these two financial institutions both have an asset holding, like a debt asset holding or an equity asset holding. This is very natural representation of bipartite networks. and looks very nice and simple in this picture. This is actually how it looks like in a real network from the first quarter of 2016 with, again, regulatory data. So the picture is a bit more messy. Here we lost the two layers, and so we have both kind of links, both security holdings, in this case equity holdings, and institutions. You may recognize some institutions with like the stars that you see outside of the core. So those stars, the center of the stars are institutions that are linked to different securities, meaning that they have those holdings. And in the center, you have this core periphery structure in this case because you have overlap between these portfolios. So the more in the center, the more interconnected you are, the more similar to others you are. And so the more similar you are, the more subject you're vulnerable to market changes. So this is again another example of the debt holdings, which is very similar, as you can see. You have also that kind of nice isolated link with an institution that just holding one security in this data set. But again, you have this core periphery structure where you have interconnected and similar institution at the center of this picture. From this picture, you can, so from this bipartite world that allows you to model very generally both contracts and holdings, you can go back to a monopartite world. This is a typical object in a network theory, which is an adjacency matrix. And this is more specifically a similarity matrix, where the entry of this matrix will tell you how similar two institutions are. And for instance, this is the equity layer of the bipartite network that we saw before, and we can see the overlap between these different institutions, and we see this community structure. And the community structure is these modules, these squares that you see on the diagonal. And most important, so you can see the same kind of structure, even with different communities on the debt layer. And the main point here is that these communities are not of single financial institutions. So these communities are not only composed of banks and hedge funds and insurance companies separate, but in these communities you may have both banks and insurance companies and hedge funds, meaning that these institutions share very similar portfolios, even if they are very different. This is the first study where we actually see this kind of large similarities between institutions of different types. And so just to say, like from a multi-layer network theory perspective, I have 18 seconds. And so these are uncorrelated layers. You see the similarity on one layer doesn't predict the similarity on the other layer. And you have this small peak where you have on one, meaning that there are some subset of institutions with very high similarity, like close to one similarity, meaning they basically share the same portfolio. They're probably following some indices. So this is just a representation of the fact that we have communities with different institutions, so different types of financial institutions, and in this work with Bank of England, we basically show that. And also, as we could compute solvency contagion and solvency contagion risk with direct model with this bipartite network of asset holdings, you're interested in price-mediated contagion, meaning the contagion then comes from the fact that we have a common asset and we might fire sale that asset altogether, and the effect of another asset holders so we have an effect on other asset holders of the same asset, sorry. And so you can compute that and try to correlate this measure with similarity and try to disentangle the different institutions in this two-dimensional space. So this is just for future perspective as we're discussing research. I think that bipartite graphs, as I was saying, allows you both to consider network of contracts between banks, so like include the case of direct monopartite networks, but also allow you to consider asset holdings. So with considering contracts and securities all together in a dynamic framework would allow you to simulate very quite realistically a financial system. So I think it's an interesting perspective for future research. And I would like to thank again Dolphin's project for all this research that I've been presenting here, and thanks again.
Thanks very much, Paolo. So last but not least, Alan.
Thank you very much. So, in order to address the question that the moderator asked, I would like to discuss with you as an exercise we've been doing the last few months together with Christopher, actually, Marco, Stefano that left the room, and Christopher, Jego Jalai that is not unfortunately here today. In this exercise, this empirical exercise, we basically quantify direct and indirect effects of of exogenous shocks, and we investigate the role of interconnectedness, so the structure of the network of contracts that we analyze. A few words maybe about the data set before diving into the results. We have exposure of 26 European banks towards sectors of the economy, and we have information about the country of the obligor. So basically, what I will refer later on during the presentation will be a combination of country and sector in order to characterize an asset class that we are going to analyze. Additionally, we have aggregate information about the interbank exposure of banks among each other, and we estimate the network according to Jego model 2013. There will be more words about that in two sessions actually in the morning. Our results are basically showing that banks are mostly exposed to the real economy of their own country. However, the second largest exposure is towards the financial sector, and it's global. This actually motivates the presence of second-round effects when distress propagates among banks. What we also find is the role of interconnectedness, and we analyze actually different structures to understand how the network, both interbank and of external asset classes, is able to amplify or dampen an exogenous shock. Unfortunately, I will have to scare you a little bit with formulas because Paolo didn't want to do that, so it's my pleasure to do that, to introduce the leverage framework. This is basically a concept that we use in all those models. We define the leverage as the ratio between assets and equity. This way, we can easily compute the relative equity loss suffered by a bank or even the entire banking system when we apply an exogenous shock. Moreover, we identify this relative equity loss with capital H or small h, depending if you are referring to individual banks or to the entire banking system. Unfortunately, I will not be able to show results about individual banks because of confidentiality of the results, but we will be able to observe the aggregated results. So, first result, as I mentioned, we see that banks are mostly exposed to the household sector of their own country. This is the dark blue column on the far left of the graph. However, we see that the second and third largest exposure of banks are towards other financial institutions, on OFI, and credit institutions, CI. What we also do is to define a way to quantify how much two portfolios are similar, so how much the portfolio of two different banks is similar, and we do that simply by taking the minimum between the two leverages of the banks observed. By doing so, we actually see that the exposure statistic change a little bit shape. We still have households very dominant on the far left of the graph. We see that the overlap between banks of the same country is huge on the household of their own country. However, when we speak about the financial system, so again, credit institution and other financial institutions, the overlap is bigger among banks of different countries. This is because, as we said before, banks tend to invest globally and not only on their own country when they invest in other banks. The results, so basically, this is a very simple graph. There is a lot of colors, but we will split everything down. On the x-axis, we have the combination of country sectors that I mentioned before. For instance, the first one is the French household, the second one, the US other financial institution, and so on. On the y-axis, on the other hand, we have the relative equity loss suffered by the entire banking system of the the system composed by the 26 banks we have in our data set. And this is a percentage, so it goes from 0 to 1. What we do is we shock the individual country sector and we see what is the direct impact and the indirect impact on the banking system. The colors represent 3 different network structures. The red one is the empirical one that is provided in the dataset. The blue one is what we call diversified allocation of exposures, where banks don't care about the location of the sector, they simply spread their investment globally. And the third one, which is the green one, is what we call the domestic allocation of exposure, where banks tend to invest in their own country. Those fictitious allocation of exposure are simply built to understand what is the role of interconnectedness in our framework. What we see is that actually second-round effects may be large and may differ a lot when we change the network structure. One thing I have to mention is that the models, of course, they need some frictions to allow for amplification of distress. This friction in our model is simply modeled by the factor R, which is the recovery rate. It can be the difference between the book value of the loan and the collateral or other sources of friction. Additionally, we have a parameter which is sigma, which is simply a market volatility of surviving assets in a la Merton valuation. What we also see is that the shock size plays a major role. Basically, here we fix the country sector that we want to shock, and we increase slowly the shock size. Again, on the x-axis, we have the shock size, and on the y-axis, we have the relative equity loss suffered by the entire system. What we see is actually that the three allocation of exposures give different results in different range of the shock. Namely, for small shocks, we see that the diversified allocation of exposure is more robust. However, for big shocks, the diversified allocation of exposure is less robust. This is in line with traditional results that we find in the literature, and actually proves that there is not, unfortunately, a network structure which is always better in any case of in every space parameter, let's say. So to wrap up the conclusion, and maybe I will try to save time with my presentation, we see that actually country sector might be systemically important for 2 reasons. One is the size of the country sector. Households usually are very big. And the second one is the position of the network, for instance, for credit institutions and other financial institutions. As I said, unfortunately, there is not a network structure which is always better. It would be nice if it was like this. Unfortunately, it's not. Those results shed light on the discussion about the capital market union, where the diversified allocation of exposure could be used as a benchmark to estimate the impact of a shock.
Okay, thanks very much, Alan. So I think now it's the time to take questions from the floor. Anyone? Someone over here? Do we have a mic? Somewhere? Okay. I think the first one was the lady down here.
Okay, my question is about fintech, and if possible, would that increase transparency? I mean, just sort of the pros and cons, we don't know, of course, how it's going to play out, but in terms of sustainability, could we add sustainability information to the, like, ESG information, if possible, I don't know, to the fintech transactions, and could that increase the transparency, and therefore, based on the first, by Marco's presentation, reduce any inefficiencies, including on sustainability in the market?
Okay, I think we'll take all the questions now, and then the panelists will then respond in turn. So, the gentleman over there.
Thank you. I have a question for Mauro. Maybe a super naive question, but do we really need replication? I mean, what is the reason of allowing replication in this financial market? Couldn't we just forbid it, this practice?
My first question was actually related to that, which is, first, when you have hypothecation, I wasn't sure what the legal structure of the liabilities, if you have a series of defaults, who gets the collateral? So obviously, as you rehypothecated, the value of the collateral is going down. And this is an issue related to a number of the models, which is, you take things like the collateral constraints as given, but if you have hypothecation, there's no reason to do that, and your work actually showed that because you showed the risk going up, and any rational person seeing that would have increased the collateral requirement. So this is a general problem of all these models of networks where you take variables like collateral requirements as fixed. As you change the network structure, those really ought to change. And so all the theorems are really a little bit questionable when you take that perspective. That a second related question in a way is the whole theory of compression. If A owes B and B owes A, that very simple one, where you would have thought, it's obvious you ought to be netting out, and they didn't. But actually, from a formal risk analysis, the netted out position risk is different from the non-netted out risk. And then the question is, was that deliberate or was that stupid? And I'm not sure what the answer to, I think it was stupid from all my discussions with the people who left these positions open. But you could make an argument there's a different risk disposition of having them netted or not. And then if you do net, and you are able to standardize in the way you suggested, why not just go to clearinghouses? Why have all these bilateral? And that was the thrust of Dodd-Frank, which was to try to push things into clearinghouses. The banks resisted that strongly. And there are two interpretations of why they resisted that. I think it's so obvious that it reduced risk. It was better for risk analysis. So maybe they love that opacity because that's the way they maximize profits. And maybe it was better for them because they shifted more risk to the government and they're always trying to maximize the bailout premium. So those are two explanations for the political discussion of Dodd-Frank and what went on in that discussion. And the final general point about the question is, what is the effect of more information? And there are two on volatility as observed. And this is put very abstractly. When you don't have information, you have what is equivalent to a pooling equilibrium across states of nature and across securities. And a pooling equilibrium is less volatile. So information inherently increases dispersion. On the other hand, when there's a lot of uncertainty, and this really, you are more likely to get credit rationing. And that shows up in these markets as liquidity problems. And I think that's really what they were getting at. But then you have to have explicit models of credit rationing. So the problem of liquidity is not a magical thing. It is just that you can't borrow. And that is a statement of credit rationing. So if you're going to analyze the impact on liquidity in this systemic perspective, you have to be grappling with what are the conditions that lead to more extensive credit rationing and how information interplays with that. And then just finally, one final comment, a general point, which is when you're looking at what is going on in these complex systems, and money is moving all around, you have to always ask, what is the benefit and what is the cost? And a lot of the benefit is associated with risk diversification, but there are multiple ways that we can get risk diversification. We don't have to have securitization. You can own shares of different banks. And then you have to talk on the other side about the cost. And the cost, from a systemic point of view, are largely related to the extent to which the system is non-conservative. That is to say, the extent to which there are real bankruptcy costs. And if it's just moving around money, then in the end, the sum of the money in the system is going to be fixed. That's by definition, and all you're doing is allocating who gets it. But I think all the interesting systems are those with real bankruptcy costs. And then you have to be analyzing the benefits that come from these different architectures with the risk of the magnitudes of the real bankruptcy costs at the system level. And a lot of these models don't really grapple with that.
I think there's another question down there.
Thank you for the interesting presentations. A question to Marco. You're advocating a lot of transparency of markets to prevent crisis from happening. If one contrasts this with the situation of Citibank, which many people say was insolvent but still liquid during the crisis, in that case, you would not want transparency to be prevailing heavily because you might precisely trigger a run or trigger a crisis that otherwise just goes unnoticed. So where would you set the threshold or this fine line? Why would you draw the fine line between when is transparency actually helping the situation versus when might it deteriorate the situation?
Any more questions? Otherwise, I think most of them were to Marco and also to Mauro. There are also a few on the screen. It seems also mainly to Marco. So maybe you start.
Okay, but shall I take the question from the floor first, address the question from the floor? Yes. So to answer about transparency, and I'll take both questions, yours and Eric's. Transparency in general. So I'm about sustainability factors. I'm not really sure. It is indeed not my field. So we can have this will be another endeavor completely. So another research endeavor. But it does raise a question of how much you want to disclose to other market participants, like to relate to what Eric was saying. So the important thing I believe here is cultural. That is the following: transparency is not either bad or good. Transparency allows you to do something that you may want to have as a desirable property when you want to intervene, right? So this is what I mean by transparency. The second point is transparency from the risk management perspective. That is, if we have data collection and individual risk managers have to finally sit on a table, abandon a complex articulated model and go into seeing the data that they own transactions, this will foster the cultural change that we need, okay? And I believe here, academia was falling extremely short 10 years ago. Because the way I learned about derivatives markets is that you can always gauge a probability, that the probability is reflected by price, and the prices reflect probabilities. How can you feed the two things together in an interconnectedness system? It was very difficult for me to understand 10 years ago when I was studying these things, and now they start to make a bit of sense. So we need to move forward. This is the point. To answer Professor Stiglitz's question about CCPs and the netting, so I believe there was a lot of, again, cultural distance from this, the ability to, somewhat intervene in a crisis at the system level. We didn't have those tools, intellectually speaking. So I don't blame people who were not able to do that, because it was impossible, because if you don't have the tools, you can't understand. At the same time, we can do some self-criticism and try to understand what is wrong. Why we didn't have those tools back then? Why didn't we do it? To answer the question on CCPs, actually, compression occurs largely in CCPs because you have more than one CCP in the system. We have a result that we haven't showed. The netting efficiency can be even much higher in a compression setting, multilateral, than in a CCP. And CCPs are highly procyclical because by definition they ask a lot of margins because they have to be flat. So there are concerns also about moving everything to central clearing, and it is important that we understand these concerns. And then the last question, I believe, was about shall I take those ones? So falling CDS market, as I said, I don't think it is a good way to look at the problem. But I believe it does answer a question. I believe, I know who asked this question, I believe. I believe it does answer another question, that is, what were all these discourses that we were having 10 years ago about sizes of markets? And I find it also very difficult. I remember asking a professor of mine when I was at the university, what does it mean that we have trillions of credit default swaps? Does it mean that people want trillions of insurance? You have an underlying market of 1 trillion, then you get 3 trillion of swaps. What does that even mean? So, yeah, so this was my question. The second point is about house marketing regulation, okay? This is the usual, Red Queen problem. Yes, I mean, it gets more and more complex. I mean, the more requirements are set to the markets, the more algorithms become complex. At least this is our perception. So this is clearly a problem. And I think also here it's cultural. Why are we teaching, why are we saying that it's good to outsmart? Being compliant doesn't mean that, you have to, it's the only requirement that you need. There is an ethical problem. Regulation is not just there to tell you what not to do, it's also there to set the guideline. So why are we not teaching this to students? I have to game the system constantly. It's a cultural aspect. In as much as you don't game your tax returns or whatever, you do it because it's the right thing to do. And then the last question, I think, about Knightian uncertainty that I want to take also because it's important. I don't like the term Knightian uncertainty because I didn't really understand what it means. I have to be honest about that. Especially when probabilities and prices are so endogenously determined. So I don't know what that means. And to just one last question is the fact that, okay, but I think I'm done with that. So Stefano is cutting me.
Okay. Yeah, I'm sorry. No, okay, I'll try to be very fast. So let me start from Andreas, and then I will come also to Joe's point. Okay, Andrea, yes, of course there is this draconian solution. You avoid rehypothecation, and yes. However, there are some advantages from it. It's clear. Now, the problem is you should handle this with care. The problem is you should try to avoid asymmetries in collateral flows, which is very, very hard to avoid. I have to say that now recently rehypothecation has a bit decreased in importance because now with central clearing counterparties collateral must be segregated, but the problem is that then is still over the counter market you have rehypothecation, and then important point is, okay, when you have the interplay with CCPs also with all these rehypothecation. Now let me go now to Joe's point. Yes, absolutely. When in presence of a collateral rehypothecation, yes, collateral requirements should be network dependent, which is something which is not taken into account. And the second about real consequences of bankruptcy shocks. Yes, of course, here they take into account, of course, they anticipate there could be bankruptcy, default, and so this generates the behavior, hoarding behavior, and then also the externalities. You are right that, however, it's still there'll be conservation of losses, and one interesting thing will be then to see when a default really occurs, because depending on the network, some transactions might not be secured at all. And in that case, then this can lead to even larger losses that we do not take into account in this so far. So thank you very much for the insights.
Okay, thank you, Mauro. So I think it's time to wrap up. So at the end, I think I would like to ask each of the panelists to, in 30 seconds, to give a take-home message of their work. So maybe we start over here.
Well, the take-home message is very simple, and that financial instability is basically an interplay of the network structure and leverage together with mispricing, and we should actually study that in order to assess the systemic risk, and to do that we need data. That's my take-home message.
Yes, we do need data, also because what we think is that network information allows to make better decisions. That's it.
Okay, thank you.
I think already made it, but I'll lend it to the next session a bit. You need to get your facts straight before you make any type of consideration about risk, and I think data allow to do that. I hope Iñaki will tell us something in the next session.
Yes, I think so. Networks and there's big some advantages, okay, in terms of higher liquidity and so, but there are trade-offs. So you can have higher systemic risk. I think regulators should look even more at the structure of networks, take them into account also in regulatory requirements and so forth, because actually they matter a lot. Okay, so that's.
Okay, thank you, Mauro. So maybe also from my perspective, thanks a lot to all the panelists and the questions. Key takeaway from my side as well, from a more central bank perspective, we will also talk about data and so on in that session, but I think jointly for all the 4 papers here is that key takeaway from my side is that the importance indeed of taking into account those externalities, the network effects and the endogeneity that you have in those networks, and that should inform, say, from a central bank or regulatory supervisory perspective, how you deal with your supervised institutions. Because, of course, today, say, the way we, as supervisors or regulators, identify institutions as systemic, we typically use very simple indicators like size, size of exposures to other financial institutions, leverage, but without really taking into account all those network effects and externalities. So I think this is, for me at least, a key takeaway from this session. We'll stop here and then give a hand to the panelists.